just wanted to welcome everyone to our investor webinar for the Foss Fields Phase I. We are excited to share this unique opportunity, and it's in one of the strongest performing real estate markets in US in Sioux Falls, South Dakota. And this is gonna be my second deal with this team because we have already partnered on Jefferson Phase II. That's doing really well because we see the exceptional results for Jefferson's Phase I, where we see the 100% occupancy already, and Phase II is closed as well. Super excited to partner on Jefferson 2 and now looking to do another deal with you guys. Thank you so much for this opportunity. And in two minutes of this webinar, I'm gonna be walking you through our small little presentation, and we'll have a Q&A, small Q&A section there as well. And throughout the presentation, if you have any questions, please use the Q&A box or the chat box and ask your questions. So we'll try to answer your questions live. Okay, so this is Foss Fields Phase I. So before I move on to the next slide or go through the disclaimer, just wanted to mention that this session is strictly for knowledge sharing purposes and should not be considered as an legal, accounting, or investment advice. And if you're looking for any legal advice, please reach out to your CPAs, your attorneys. This is merely a knowledge sharing session. So the next slide is the summary, but before we dig deep into the summary, I'm gonna ask Caleb to tell us the story behind this project. How did you get your hands onto this project? Because it's a really exciting story, and I would love everybody to hear that.
Thank you, Vinki, for having us. Yeah, where to start? Okay, so a couple years ago now, this piece of property was came available on the market, and it really wasn't publicly listed as much as it was sent out from a local real estate broker to developers in town. And what was interesting about this particular real estate broker is he was an heir to Joe Foss, who's a World War II hero in Sioux Falls. Our airport is named after him. He was a famous fighter pilot. Joe has passed on, but his heirs now owned his homestead where he grew up. And that's where this house, his homestead and his house is actually where this 14-acre master parcel sits. And so that was just a really cool feature about the land itself. And just being from Sioux Falls and growing up here and hearing all the stories about Joe Foss has been pretty cool. So we actually started engaging with the family and the broker and talking about how we were going to be able to put this together. And long story short, we actually got the land under contract and some other land next to it as well, almost 18 acres of ground. And there was no development yet. So in that whole, well, they're developing around it, but not that particular 40-acre chunk hadn't been developed. It didn't have the water, the sewer, the streets in it. And so we actually won the bid, so to speak, by being the most flexible to work with them during their development phase. And we worked on basically giving them a little bit of money during the development, placing it in escrow, and that would allow us to buy it for whatever the fair market price was when we closed on it, which we did pre-negotiate. So what was great about that is we now have control of this 14.5-acre master parcel, and that's where we're getting this Phase I, Phase II, Phase III, Phase IV for the Foss Fields project on the old Joe Foss homestead. So today we're going to talk about Foss Fields Phase I, 3 acres of that 14 that we're going to start off with in this development.
Thank you so much. And just wanted to remind everyone, Foss Fields Phase I is 100 units. It's going to be ground up development. So a question I'm going to ask you over here is, when you were looking to get this deal, what makes this deal stand out compared to others in this current market? I mean, you might have done that analysis, right, before you got your hands onto this.
So like about this piece of ground, one of them is it's in a nice elevated area. You know, in South Dakota and in the prairie, there's a lot of places that have lower elevations and are in sloughs and marshes. This is not one of those. So just from a practical standpoint of avoiding any stormwater issues or slough issues, this doesn't have any of that. It sits in a very growing part of the city of Sioux Falls on the east side. north of a large, like basically the second largest retail pocket of the city of Sioux Falls. It just sits north of that. There it is actually in the Brandon School District, which is a neighboring community to the city of Sioux Falls. And the Brandon School District is the best school district by a lot of different metrics in the state of South Dakota. So it has that, and then the outside of just Sioux Falls generally being a good place to invest for reasons I'm sure we'll get into tonight
Mhm.
is the major thoroughfare. There's a major thoroughfare that's connecting I-90 and I-29 in the city of Sioux Falls, and that's called Highway 100. And if you look at a map, there's I-229, which is already connecting those two, and farther out in the city during, as it's grown more, now Highway 100 is connecting it with another quarter circle around the city. And this just sits just inside of that Highway 100. And by inside, I mean inside the city limits, closer to the heart of the city. And so it's got a very nice traffic pattern. And it's got very easy accessibility across the city as well.
Let me piggyback on Caleb's comments here. On that Highway 100, just to the south of this, where the East Side Mall is, Dolly Farms, it's the East Side Shopping District. They are redoing that intersection. That's the largest intersection in the state after they get that redone. So that's how much traffic is going to be near this intersection. And then to talk more about why the deal is good, not just from a ground perspective, this is little A affordable housing. So it's not government funded. It's not Section 8. It is a mixture of the cheapest build you can get, as cheap of construction as you can do, mixed with A-class construction. So the structure is as inexpensive of a structure as we can build, but the interiors are the same quality of units you'd find in a downtown flats. So we separate ourselves from the competition, where we're not a downtown apartment at $2,000 a month, but we're also not the cheapest apartment, because we have these really nice interior finishes and we have a very modern exterior. So we like to call that little A affordable. It's not Section 8. It's not federally funded, but it is very, very affordable for everyone to rent.
Yeah, thanks for sharing that. So I'm going to start with the first slide. I know usually people have the returns kind of in the middle of the presentation or end the presentation. So I'm starting the opposite way. So I wanted to start with the returns, what it looks like from the investor perspective. So anybody, maybe Omar, you wanted to talk about this slide, what the numbers going to look like for investors, and a little bit about the loan too, if you can give us some insight on that.
Yeah, it's first of all, Vinki is a very shrewd negotiator, and she has beaten us over the head in trying to get the best deal possible for you. I didn't want to do this, but Vinki has both a shrewd negotiator slash beaten us down. So the deal you're looking here is possibly some of the best we have basically been able to provide for investor, and all the credit there goes to Vinki, I must say, because I'm not that generous usually, right? That being said, I mean, the biggest thing over here is that we have about roughly a 65% construction loan. Now, Caleb can attest to this as well. We've underwritten to a 7% interest rate, but we were just discussing in the morning, because Caleb, Dustin, and I, we have a Tuesday morning call to discuss, everything that's going on in our portfolios. And current rates right now are much below 7%. So what that tells you is it's a lower leverage loan at 65%. It's totally fixed rate, and on top of that, the fixed rate that's underwritten is higher than the actual rate we are getting right now. Now, the loan isn't closed, but the reason why we do that is to build all these buffers, because while everybody can talk about returns and, you're going to make this much money and that much money, the first principle is always trying to take as many steps as possible to protect your base capital. And having a lower leverage fixed rate loan, which is underwritten to a higher rate, but we're actually getting lower rates right now, that is something that is, I feel, the most important aspect over here. Other than that, this is the first of potentially 4 phases. There's going to be 100 units here. Later on, Dustin and Caleb particularly should highlight, not just how they construct, because Caleb's real and Dustin's really good at that, but also why they are designing that way. Because I think once you understand the design element, you marry it with the construction costs, you'll understand that in today's environment where interest rates are higher, they're not zero interest rates anymore. the process, the way, and the structure our team has basically put together for these reserve style developments. By the way, this is our 10th iteration across our 8th project for this type of project. This model is very powerful both in today's market and especially when you have a better market in a few years when you're looking to exit. So that's that in a nutshell. I don't know what your next slide is, Vinki, but I do think Dustin and Caleb should maybe start talking about how they're developing, and Dustin can really talk about the vision and then the interiors and how we go about it that way.
Yeah, no, definitely. We'll go through that, dig deeper in that slide. But I wanted to, I would like you to mention something over here, because last time we got a couple of questions on the construction loan, because that was a ground up project as well, Jefferson too. So if you can shed some light on that, how the construction loan works and how it's different than the value add a little bit over there. So if you can take a minute and then tell us, how there's a draw schedule for the construction loan and how exactly it works.
So here's how it works, basically in a nutshell. Obviously, I'm providing a simplified example. So, example, if we have to go get, I'm using simple examples because if I go down to the second decimal point on this, you're going to get confused. Let's assume somebody gets a $10 million loan. And the bank says, look, in exchange for a $10 million loan, I need you to provide us with $3 million of equity. I'm using numbers, round numbers, right? Or $5 million of equity. How that happens is then now they've approved the loan, they've approved the plans, you've negotiated everything, you have a loan, you have interest rate and everything on it. But all their money is not given to you up front. What happens is first, you go through the $5 million in this case of equity that you have raised, which the bank said you should raise. You use all of that to invest in the project. Then when those funds are exhausted, then you start drawing upon the loan. So they don't give you the entire loan in one go. Maybe what happens is once you've used the first $5 million to develop, every month you might only need $800,000 or $1 million. So as you need the money, that's where experienced GCs and developers like Caleb and Dustin would come in. They are going to not only match the pace of construction with how much interest rate management, but also that's how you draw upon the loans and funds. It's not they just give you all the money and then you start doing it. They want to see progress. Each draw, this is called a draw because you are asking for money and you're drawing it from their account. Each draw is managed by milestones that you have to reach. So this way, nobody gives you 100% of the money. As you do the work, as you do the pre-agreed budgeted work, that's when you keep getting the funds in your account.
Thank you for sharing that. And once again, I wanted to say here, the total capitalization is 16.3 mil. And now with the loan is 65%. And we're trying to raise around $6 million, the equity, right? And
Yes.
these returns come over here about 18% IRR with 22.3% annual average return. And this is the baseline. And this is a stress tested as well. And we'll take you to that slide as well in the preceding slides. So the next slide is again about the returns. If you're investing 100K, you're looking for 8% preferred return with 18% IRR and 1.8x multiple. Like I said, this is the baseline. And these are the numbers that shows you basically on 100,000, what the cash flow is going to look like. The cash flow is going to start year 2. We call it year 1 because the year 1 is a construction. But year 2 and 3, because it's a 45 months project. At the end of the project, at the exit, we are looking for a baseline about 180,000 plus return altogether. So now I'm coming to the conviction, structure, and strategy. I think this is one of my favorite slides. And any one of you, if you can talk about that, this project is rooted with a clear vision, solving the affordable housing problem with some innovation and efficiency and all the things that you learned in the previous project, you're bringing it here, all the learnings. And I think Dustin has something to share with us, right, regarding this project on that. Dustin or Caleb, anyone?
Yeah, I can talk about this. This is kind of where I come in. Affordable housing, solving the affordable housing crisis is my passion, mission, and purpose. And we've been working on this for actually quite some time. We just didn't understand it. And so in the past couple of years, we realized that we actually have a really good plan for solving the affordable housing crisis. The more of this stuff that we build, the more pressure that we can put on all the rents around where we're at and keep the older product a little bit cheaper, because our product is so nice and new, people would rather live in this than the older value add stuff. So if we can come into an area, we can actually keep other prices down while giving really good returns for our investors. So it's for purpose and for profit. We do this through a lot of efficient design. So the design, we design very efficiently, and we design it to be efficient also on the maintenance. So we have very few hallways. We have minimal hallways. We have a stairwell with a vestibule where you enter into the units. We eliminated all the elevators because the elevators are maintenance nightmares. They're super expensive to maintain. And we found that it doesn't impact our tenants. Our tenants are not asking us to install elevators. Our main floor is where all our ADA units or our handicap units or our accessible units are all located. Any common spaces are actually on the main floor as well. It's all zero entry. There's no subterranean square footage, which is good because then we don't have mildew issues or any flooding issues that I have to worry about. We focus on core amenities. So we have very attractive exteriors and very attractive interiors. There's a sense of pride of ownership because a starter house is almost out of the question for anyone coming to the market now. So this is like the new starter home for many people. So a brand new apartment, super nice neighborhood. And we focus mainly on the unit itself. And then we like the suburban locations close to urban core. So you have accessibility to all the jobs and all the entertainment, restaurants, all that stuff, but still live in a very safe suburban neighborhood where you have space, you have a connection to nature. And the main amenities we focus on are the floor to ceiling windows, the quartz countertops. We do a Scandinavian interior design, so it's a white on white palette, raw wood floors, taupe trim. The upgrades are like black hardware. We have washer and dryer in each unit. We have beautiful mirrors and lighting. We have windows in the bathrooms and closets on some units. So we get light that flows through multiple directions in the home, and it's very, very nice. We design these units to feel bigger than they are. So like a standard one bedroom, 600 square feet, whereas most apartments build at about 700 square feet. And tenants rent on bedroom square footage and quality of amenity or quality of unit versus square footage for the most part. Especially our demographic, which is usually young professionals or empty nesters, is what we find is mostly our demographic. So we have extremely good tenants that are paying their rent on time. These are Instagrammable units, so people care about their image. They care about how they look, and so they keep their unit. They tend to keep their unit a little nicer. We've eliminated things like underground parking because it's super expensive to build and maintain, and people just don't want to pay for it. So anything that has a low ROI, we eliminate, and we concentrate on amenities that improve the ROI. Dog parks do not improve the ROI. We removed them. People can walk their dogs in the green space that we have on our property. We don't have pools. We don't have hot tubs. So all the stuff that's very high maintenance that people think is attractive, like, oh, that's attractive, I want that in my unit, but they don't really use it. We eliminate that stuff, and we give that rent back to them. So we lower the rent price as opposed to giving them more amenities. And we found that so many apartments are coming out with amenities that we are the option that doesn't have all the amenities, and we are renting much quicker with a better long-term prospect on the income as well, because it costs a lot of money to maintain those amenities, and we feel that's something that these developers are kind of overlooking. And as insurance gets expensive, taxes get more expensive, maintenance gets more expensive, it's harder to find talented maintenance guys that can fix all that stuff. We're finding that these apartments are just much easier to operate. So it takes less employees to operate our units than when you go to the A-class units. It takes a lot of employees to keep those units up. And then with all the common space you have to take care of, it always has to be pristinely clean. Otherwise you'll get complaints. If the elevator's broken, you'll get complaints. Your reviews will go down. And it costs a lot of money to upkeep all that stuff. And we've realized by removing a lot of the stuff that the tenants don't care about, these units are much more profitable. And it goes, we also do a copy and paste where we're using the same unit, and so we don't have the architecture and engineering costs of redesigning a building for the lot. We just place these buildings on the lot. So the civil engineer is the only custom design that's done on each site plan, because the buildings are just not necessary to redesign every time. So we use the same building. We've improved the building over and over and over. Caleb knows exactly how much these cost. He knows how much the time to build takes. And so we are really replicating the same thing over and over, and we're perfecting it, and we're getting good at it. And we take the tenant's feedback and we apply that and continue to make each iteration just a little bit better. And this is a cents game. It's nickels and pennies. Like, we make money on the razor thin margins on this game, and then by scale. And that's Omar's specialty, but that's what he always talks about, is if you can save a percentage here or there, it really adds up, because the scale is so large on these projects.
So you mentioned something, you say you don't have the underground parking, so the parking, but there is parking, right, at the ground level?
Yeah. Yes.
Yeah.
Yes.
Okay.
Yeah, there has to be parking. It requires a certain amount of parking. It's just not underground or heated or cooled. And we found that people don't pay for that. They will not pay. So it should cost $100, and maybe people will pay $50 for it.
Okay, so other
just to just to provide you some context, a lot of times developers, especially when interest rates were zero, right? Because it doesn't cost you to do anything more, right? It's not as punitive. Right. A lot of times developers we saw were asking the questions to their residents to say, hey, would you like this thing? Well, the short answer to would you like this usually is yes, because it doesn't cost me any money. The real answer is, are you going to pay for this? Because if you ask me, do I want a private jet? Yes. Am I going to pay for it? No. So the real question is not would you like to get something, it's like what amenity, what feature, what type of unit would you like, where you're going to pay us the maximum value for the cost we have. And balancing the cost and the benefit is what is the real, at the real heart of this model.
Yeah. There's a question from Kyle. Kyle, we're going to get to that in the preceding slides, but I'm going to ask the question anyways. Good evening. How many full cycles have you guys done? And what year did the company start? Any capital calls or bankruptcies so far?
So no capital calls, obviously no bankruptcies. Otherwise, we can't even sign on loans. Full cycle deals are, it's in your slide over there, right? If you go down, you can see it.
Yeah, we'll go there. Let me go.
And full cycle, you can see. I started after about a decade plus in investment banking and private equity. I started in 2017. Dustin and Caleb, when did you start? You've been doing it for way longer, basically.
I've been doing it since 2002. So I've been through the 2008 recession. I've been through also through the COVID recession. And there's been some little mini ups and downs since then too. 2016 was a hard year. So yeah, I've been through some ups and downs for sure.
Yeah, but no capital calls, right? So far together.
No, guys. Otherwise, if that's the case, we can't even raise money.
So
yeah, no capital calls.
Yeah, there's multiple current projects that's been worked on. So we'll go through that for now. Let me go back to our previous slide. So I wanted to ask you one question over here. So this is the opportunity. It's a 300 acres master plan. And the model is, or the approach is build, lease, build approach. What exactly build, lease, build approach is? If somebody can shed some light on that.
Yeah, so why don't you go ahead, Caleb, please.
What we're building with this particular type of product is a smaller building. And so, for the Foss Fields, it's a 25 unit building. It's 100 units total. So there's 4 buildings that will be part of this project. And so we start the construction, and it's the whole 100 units that we're doing, but not all 100 units get completed at the same time. Within the first, around 8 months, you're delivering building 1. Let's say it's a 14-month construction project. You're going to be delivering building 1. You're all your parking lot is done and all your foundations are done, but you're delivering building 1 first. And it's kind of similar to an assembly line where you're moving from building 1 to building 2 to building 3 to building 4. So building 4 is still, 4 or 5 months away from being completed, but building 1 is completed and you can gain occupancy in that building because it's a separate structure. And so we're leasing building 1 at month 8 of construction. And this also goes back to what Omar was saying. Like, we're going to use our equity first. So we're trying to shrink the timeline of when you start paying interest to when you start receiving rent. And in order to do that, you're putting these buildings online kind of in a first done, first served kind of way. And that allows you to build and lease building 1, finish building 2, lease building 2, finish building 3, lease building 3. And that's where that build, lease kind of mantra comes from.
Okay, so I'm going to ask you this question here. How has this phase strategy worked for your past projects? I think you did something similar to the Jefferson as well, right?
Exactly.
Because you're able to lease that when the other
Yeah.
buildings are in the construction
So
phase.
just to give you some context, guys, for our past projects, we are over 95% occupied across the portfolio. Now, to give you an idea, typical developers, you have to understand, they deliver their first units, they all say 18 months, it's really 20 months, give or take. We are delivering first units between 8 to 10 months, entire project between 14 to 16 months. And it's not estimate. We've done this before multiple times. Caleb and Dustin can shine more light on this as well. And by around the 18-month or so mark, when other people are claiming to deliver their project, we are already 90 to 95% occupied. The biggest reason why this is important, obviously, is the quicker you have cash flow, the better it is. You're reducing the time, it's less risk in the project. But the bigger deal also, especially from our debt point of view and financing point of view, is that if you have, say, a 4-year construction loan, anybody that's leasing, whether that's us or some guy with a bigger, shinier tower, your first set of leases typically have a concession because you have to encourage people to move in, right? You have to lease up. Now, when you are on a loan, it's a finite amount of time. So the quicker you get your first leases, the quicker they burn off, the quicker you can take off concessions, the higher you can get rent. So by the time your loan is expiring, your income is maximized, which gives you the best possible probability of either selling and making money or refinancing and returning a lot of money and still cash flowing. That's why these things are very important. But Caleb, why don't you talk about Jefferson Reserve? We're 100% occupied, Aspen Ridge, Maple Rock, Briarwood, all these other projects.
Yeah, we've done this across multiple projects. Jefferson 2 is probably the most recent one, and Vinki is invested in the phase 2. Sorry, Jefferson phase 1, and Vinki's invested in phase 2. So we started. Okay, we'll just do it by months. We started construction. It was 84 units. It was across 3 buildings. We started construction obviously in month 1. In month 9, we delivered the first 36 units. In month 11, we delivered the next 24. In month 13, we delivered the next 24. And in month 14, we were 100% occupied because we had been leasing since month 8, about a month before the first building opens. So we had 6 months of leasing, and we only were 1 month out from finishing construction.
Great. So another question that I'm going to ask you over here is, what projections are in place for investors during the early construction phase?
Sorry, can you say that again?
So what projections are in place for investors during the early construction phase? I think this is one of the questions I got from one of my investors. So basically, I would say from the projection state of point, because we are not making any distributions right until year 2 in this project or any of the past projects. So that's what I think my answer would be, but I wanted to run it by you guys,
No, first of all, guys, in a development, there is no way for anybody to give you money legitimately because something has to exist before you give money, right? Now, in the past, Vinki and I have discussed this, so I'm not going to take any names. We know of developers that are saying, we will give you a preferred return during development when the thing isn't even out of the ground, okay? Some people like that. all I will tell those people is you need to get your head examined and you need to start thinking like a normal person. Because if something is not out of the ground, it cannot cash flow. And if it can't cash flow, how is somebody giving you a distribution when money does not exist? So basically, we are honest, we're upfront, and we say, this thing takes X amount of time. Here's a track record on how to do it. And here's how you get your stream of payments. Now, unlike a typical value add acquisition, where this gets really interesting, obviously under Dustin and Caleb's leadership, is also that we're building to an energy efficient core. This points to, I think this was an aspect Dustin alluded to, but didn't, I don't think, did you say the energy efficient point, Dustin?
No, there's so
No.
much stuff that we're
Yeah.
efficient on it. I could talk about this for 4 or 5 hours.
Yeah, so the energy efficient point, guys, is very important because Dustin's vision, Caleb's building and vision, we're building an energy efficient product. Now, when we say, hey, you're going to wait for a distribution in year 2, the real important aspect here is you're also going to get tax credits. Tax credits, in effect, are a distribution of sorts. It is just given to you in a different way because tax credits, you can be a W-2 employee, you do not have to be a real estate professional, and it is a one-for-one reduction in your taxes. So I think typical tax credits are 4 to 5%. So think about it this way, 4 to 5% straight cash is just deducted against your taxes. This is not like depreciation. With depreciation, you have to either be a real estate professional to use a full amount, or you have to keep carrying it forward in future years. Tax credits are very, very, very powerful, and anybody with a regular W-2 job can use them. Those are also passed on to you. That's why you can offset that against your taxes, and it effectively acts as another distribution for you.
Yeah,
I
I
do
do have
wanna-
a slide on that, so I'm going to ask you that question so you can walk people through how exactly it's going to work. It's dollar to dollar. I think it's dollar to 2.7. That's what you mentioned earlier.
Yeah,
So
yeah,
I'm
yeah.
gonna
Compared to
explain that a little bit
depreciation,
more.
it's too
Exactly.
much more. But Dustin, you had to say something.
Yeah, I want to piggyback on what Omar said, because a lot of people think that they just will invest in a real estate deal and they'll immediately get distributions. If the real estate deal is not at a level above a DSCR of 1, if you're not way over DSCR of 1, you can't really give distributions. And so if you're getting distributions from a deal that has less than 1 DSCR, that means they're borrowing money to pay you a distribution, which waters down your return in the long run. And so anybody that's on a development, because the development clearly has a way less than 1 DSCR while it's getting built, and usually for the first 2 years it has less than 1, or 1.5 to 2 years it has less than 1 DSCR, because like Omar said, there's no income coming in. If it's less than 1 DSCR, they are borrowing money from your project to pay you a return, to pay you a distribution. So you have to keep that in mind. Check the financials. If it's less than 1 DSCR, they're just doing financial engineering, and your return is getting watered down.
Yeah, thank you for sharing that. And most of the, I think, value add deals too, they do not start the returns right away. They take 6 months to a year, sometimes 1.5 years before they start on returns. And this project is really cool. This is a ground up project, and we're looking for something really bigger and better. And especially given the track record of the builders, the previous projects, we can see that their delivery time is like really, really fast. And they're leasing up really quickly. I'm really happy to see our Jefferson 2 project because Jefferson 1 is already sitting at 100% occupancy. So it gives me like a lot of confidence that Phase 2 is going to do as well. So let's talk about the Sioux Falls market. It has a very strong economic fundamentals, low unemployment, rising income, and then the tight rental supply over there. So I do have multiple slides. Who wants to take a shot at it? Yeah.
No, I mean, I can go for it, and then you guys can chime in. Guys, first of all, Sioux Falls is one of the strongest employment markets, if not the strongest market in the country. Not in the Midwest, not in the upper Midwest, not in this little corner where people have 15 exclusions, pretty much in the country. As you can see, this zip code, basically 57110, has a 0.9% unemployment rate. Okay, I live in Dallas. Dallas is, by and large, one of the hottest big cities in the country, if not the hottest big cities in the country. I don't think even in Dallas's best year, they've never had 0.9% unemployment rate. Okay, that just gives you some context. Median household income is very healthy at $87,000. population growth since 2020 has been 19.7. And these charts, and there's a chart after that, can really put this into context. Here's the deal, guys. The deal basically is that the two biggest factors you're looking at when you're investing in multifamily are household income and unemployment rates. So if you look at basically the unemployment rate, what you're seeing over here across, this is, by the way, freely available information. You don't have to subscribe to an expensive industry database or rely on our words. The source is right over there, Federal Reserve Bank of St. Louis. From 1990 all the way to 2020, we looked at a big study to see Minnehaha County, where this is, South Dakota, Sioux Falls, and Texas, Florida, Georgia. Consecutively across business cycles, unemployment, as you can see, is consistently by multiple factors lower than these hot economies that you hear about, right? This means people are employed for a longer period of time, even through recessions. So people have money. Now, the next question on the next slide is, well, if they have money, what is the growth rate of that money? Because it's no use you have a job, but you get paid minimum wage, right? So now, as you can see on this chart, again, from the Federal Reserve Bank of St. Louis, what it shows you over here is not only is the median household income higher than Texas, Florida, and Georgia, the growth rate of this income, this gold colored line graph or whatever line that you see basically at the bottom, that shows you not only is that income higher than Texas, Florida, Georgia, the growth rate of that income is higher. This means more people are employed for a longer period of time with a higher growth rate on their income. So that tells you the power of this market and this submarket. Caleb and Dustin, there might be some other stuff that you have to say because you are very familiar with the markets as well.
I would just add that the reason for this is a very diverse economy. Finance, a lot of credit card industry here because of the interest rate laws, or the lack thereof, I should say. Agriculture, healthcare. Sioux Falls is a major regional hub for healthcare that's drawing in from a lot of neighboring communities. And then kind of all the things that spill from that: construction and retail and government jobs. So it's a very balanced economy. And that's why it's continued to grow. And it's a very business friendly state and city. And so that has really helped the growth factor as well. Low taxes, all of that stuff.
Yeah, so I want to piggyback on that. Zero tax. So there's no state income tax on your return. So when you guys go and when you make money on this investment, you're not going to pay the state of South Dakota any tax. So it's just federal tax, or it's taxed in your state that you live in. The other thing is we've had about 2.5% growth for the past 40 years. And the climb is very, it's just the same year after year. It's very consistent growth. The leadership of Sioux Falls has been incredible in putting a path of progress, a path of growth for the developers to work on. And I've been told my whole life since I've lived there that it was a city that had a plan to get to 500,000. And that is exactly what's happening. And they say a town will grow to 500,000, and then now that from 500,000 to million, you need a little bit different plan. But we're at about 300,000, and from 300,000 to 500,000, that's a lot of growth. It's going to almost double with just the projected growth that's there. And so I see a path where it's easily growing to 500,000, and that's a lot of people that need units in homes, and that's what we're building. At the same time, there's almost no single family homes that are being built, and it's like that across the nation because they're too expensive. The single family homes have fallen off a cliff, and this year there's been very few multifamily permits that have been submitted as well. So the growth is in the construction market is dying down because it's too expensive to build. And so we're trying to fill that gap, and the growth is still there. So it's a really good market for all the future metrics.
Okay, that sounds good. And then you want to talk about this demand and supply slide over here, Omar, a little bit. Give us some insight into it.
Guys, so the other deal also is pretty much, while people will tell you about very complex economic theories and this and that, at the end of the day, we're in a very simple business in some ways, right? It's demand and supply. It's economics 101. And here's the deal. If you have a very growing part of the country, right? Well, people need housing. And the fact of the matter is that as long as there is a lot of demand, but less supply, you're always going to have an upward pressure on housing. So if you can look at, where there is a dashed line called forecast, to the left of it, you see that deliveries were very high. Now, why are deliveries really high? Because the reason is interest rates are very low. As we discussed earlier, a lot of developers started, or a lot of people actually, I wouldn't call them developers, started building because interest rates are low. They thought, okay, well, even if I make mistakes, I can figure things out. A lot of those people, developers, syndicators, value add people now, when interest rates are higher, are finding out the hard way that money doesn't grow on trees and it doesn't fall from the skies. But the biggest thing for us on a go forward basis, as you can see to the right of this forecast, this dashed line, is that while the population continues to grow, there continues to be a housing affordability issue. As we, pretty much anywhere in the country, there is a housing affordability issue. Because of high interest rates, a lot of projects are not being penciled, and therefore supply is practically zero, getting especially into the latter half of 2025. Why is this important for us? The reason why this is important for us is because when there is less supply and more demand for a product, the probability states that the value of that product goes higher. Especially if there is like one or, about 1.5 years where not a lot or zero supply is delivered to the market, then then supply is always playing catch up in demand because now you have a big lag. So this is from CoStar, by the way, again, third-party data, not just our opinions over here. And this is very pronounced in Sioux Falls because you can see practically nothing is being delivered in 2025.
Interesting. It's right here. You can see it's all flat. So given that demand and supply, and also the job growth, the unemployment rate, and the median income over there, how are you factoring the future rent growth into your underwriting for this particular project?
No, we are still very tepid on our rent growth. It's between 3 and 4%, depending usually going forward. Industry databases, brokers we talk to are telling us basically that it's going to be much higher, number one. Number two, if you actually go to the unit mix slide, please. It tells you the units and the mix. It's next page over here. As you can see over here, guys, look at the pictures on the left side. This is a class A++ unit that Dustin has designed. Look at the rents which are at the bottom right, 1,200 and 1,211. You can see the mix by various unit types. You are getting a newly built apartment with state-of-the-art facilities, great interiors, for a mix of $1,211. People can't find 2 bedrooms or bigger 1 bedrooms for that in most parts of the country. So we're providing a really quality product at a very competitive price. And again, the reason why we can do that is because Caleb, Dustin, and our team, we designed this model to have a lower overall cost. It is still a dollar and cents game. A lot of guys, the dirty secret is a lot of developers, they are forced to charge these sky high rents, $2,000, $3,000 for a studio bedroom, or sorry, studio apartment, because their costs are very high. So they have to have a higher rent just to justify their cost. In our case, because we manage our cost, it's a dollar and cents business. Therefore, we are able to drastically reduce the rent, fill up quickly, and then as markets go up, we radically adjust our rates up. But we go in assuming we're going to get lower rents.
Perfect. So I'm going to take you back one more time. This is the site plan. So there's going to be 4 phases like Caleb mentioned earlier. And I think this is the phase that we're working on right now that you can see the blue line around. East phase 100 units. Please correct me if I'm wrong. Is that correct, right?
That's correct.
Yeah, so this is the phase that we're looking at right now. So there's going to be another phases after that, which is going to run simultaneously once we're done with phase 1. And this is the floor plan. It's going to be 3 floors, main floor, second floor, and third floor. I think Dustin touched on that a little bit earlier. So no elevators, kind of very simplified approach. So easily manageable project, less operational cost that way. So here's the unit mix. We have a lot of one bedroom units. So I do have a question for you here. Why such a high percentage of one bedroom? Is there like a more demand in the area for one bedroom? What is the reason behind it?
Yeah, the one bedrooms are the most sought after in this market. Most developers did not build very many one bedrooms and even fewer studios. So we throw studios in the mix and one bedrooms. Two bedrooms are actually our hardest unit to rent, believe it or not. I don't know if it's a price sensitivity issue or because most developers strictly develop two bedroom apartments. But we're seeing more and more people want to live by themselves, and it's much more affordable to live by yourself in a one bedroom than a two bedroom. And job wage growth is not keeping up with apartment rent growth, so their one bedroom's just much more affordable, and we're seeing people grab the affordable option all the time. There was a study done that said that we needed like 7 to 10,000 one bedroom units in Sioux Falls. It was an affordability study. And so the demand for one bedrooms is very, very high.
Interesting. So do you anticipate the unit mix affecting the lease up speed at any point throughout the project?
Yeah, it's faster. When we have more one bedrooms, it's actually faster.
Oh, okay, that's good to know.
Yep.
Okay, so the next one, the slide that I have is on the construction cost. So this is the total project cost. I think the hard cost per unit is gonna be 140K. So anybody like to talk about this slide?
Caleb, why don't you take over?
You know, I think the slide generally speaks for itself. One of the questions I saw in the Q&A was, how will you handle a probable increase in construction costs to build this? And likely with tariffs unknown, if lumber costs will go up, have you accounted for that possibility? Yes, we have. We have a 5% contingency inside that hard cost number, inside that 140K unit. And this is not a building that we are building for the first time. You know, this is a building, man, the 45th or 50th building of this type that we've built. So we have a lot of predictability in the costs. And so with yes, we're going to probably see some pricing increase on the material. It's interesting, in the Wall Street Journal today, they did a survey of 400 CFOs, and ones that were relying heavily on imports from Canada and Mexico and China expect to raise their prices by 5% this year. And so it's not this 15, 20, 25% that you're going to see that you hear about in the tariffs, is that how much that stuff is going to actually go up. And there's a couple things that play here. Yes, materials is a huge part of what we put in, and a lot of it, and some of it is imported, not a lot of it, but a lot of it is not imported. For example, your aggregate mix, your asphalt, your concrete, and your labor. And so when you see the permits falling off, like how Omar showed that, but you might potentially have some increase in material, you also have some hungry subcontractors that really need to make sure that they have enough work. And so you're balancing that negotiation at the same time you're balancing your material in the negotiation. And not only do the subcontractors need work, but the material suppliers need to sell material. So there's a lot of competition in this marketplace for all the people that want to build this product. And you also have people building the product that have built it so many other times before, where they're going to be able to drive their own efficiencies and keep the cost down.
I can also attest that the times when people were freaking out the most about pricing going up and not wanting to build during that time, it didn't turn out good for anyone that paused their construction during that time. Because what happened was the prices went up and then they kind of stayed up. So it would have been cheaper to build before the pricing goes up. Also, if people are scared of the tariffs, there'll be less people building apartments as well. And so I've found building during a time of fear, like in the middle of COVID, that was one of the best buildings I've ever built, because everything went up drastically right after COVID. Everyone paused, or a lot of people paused construction during COVID. We didn't pause anything. It was actually too late to pause. And we went through it, the whole project. It turned out to be one of the best projects ever. And pricing went up. The value of that building went way up after that, after we built it. So if the tariffs do kick in, there's also value there that's going to increase with our units, because our units are going to be more valuable, and more than likely there's going to be less people that are building. So I found that price increases don't affect you as much in development, because a year later those price increases has affected the overall supply, and now rents are a little bit higher to justify those prices.
Thanks for sharing that, Dustin. That's very informative. So now getting to the slide, the rent comparables. So what do you see, for the Foss Field is pretty comparable in the area, the rents that you're projecting to get on this project?
Yeah, look, as you can see over here, they're not only competitive, in most cases, they are lower than what other comps are getting. Now, just for the record, the reason why some of these are lower is because, like I told you, a lot of times, guys, it's not necessarily that the developer always wants to charge higher rents, because the developer, or any asset owner for that matter, they want to balance rents with total revenues and profits. And oftentimes, if you charge too high of a rent, or you charge too high of a price for your product in anything in life, you might not get any customers. But in the case of most developers these days, the reason why they've got to do this is because their costs have been so high. So they have to find a way to, justify their costs. That's why, obviously, while we use the comps as a guiding post to see, can we pencil our returns? Is it possible? The reason why we are so competitive is the cost structure for us. That is a real competitive advantage.
Mm-hmm. And then all these comps that you shared over here on this slide, are these comps similar? Do they have similar amenities like the Foss Field?
Some might have a few more amenities, but for instance, in the case of Powder House, which is the mustard colored one, I mean, it's over there, but this mustard colored thing, half of their amenities don't work. Like they have a golf simulator. The golf simulator has been broken for the past year. Why? Because again, you spend a lot of money, nobody accounts for maintenance, and when things break down, you don't have money to do it. They have a hot tub, that thing's been perennially broken down. By the way, just on hot tubs, we put it on one of our assets and we realized it's just a pain, basically, like constantly things are breaking down. That's why we never do this again. I don't know, do they have a swimming pool at Powder House or no?
I don't remember. They might. They have all kinds of stuff. And what's
Half of
happened
it's
there,
broken all the time.
yeah, and then what also happens is now it's branded as the party development. And so they get lots of turnover, lots of transient tenants, and they only cater to young people that want to socialize and party. And some people, like, it's kind of branded that way. Sometimes that can work. Like if you're in a college town, that can work. It doesn't seem to be working that well with the direction it's going, in my opinion. But I would say though that if you walk through every one of these units, that the interiors that we put out there are better, and our buildings, our exteriors are more attractive. So we just have a more attractive product. So we might not have the amenities, but where the people rest their head at is a more comfortable unit.
Right, and they're charging a lot more, right, than what you guys are projecting.
Yeah. Yep. You can see that over there, basically.
Yeah, exactly. If they're providing the amenities, they're charging a lot more as well. So moving on to the project timeline. So what do you see over here? I mean, what is the biggest risk hitting this timeline? What could go wrong? That's what, if you can share with us.
Caleb, you want to take it? I can tell you this, guys. The biggest risk usually is zoning, permitting, all of that in place or not. Because a lot of times people raise money first and they're like, oh, we'll handle whatever government agency we have to deal with. And that's when bad things happen to good people. All of that is done, but Caleb and Dustin can shine more light over here. This is a shovel-ready project.
Yeah, typically the things that can go wrong is the seller doesn't sell you the land. You have it under contract and they don't sell you the land, or it falls through for some reason, or soils or easements or something. Since we've controlled the land for 2 years, we don't have that problem. We're just contributing the land we already have into the project.
We own the land.
Yep. Density, whether they're going to be able to pencil the project, that's already been approved. Permitting, we don't actually have the permit yet, but we should have the foundation permit any day, which means if you get the foundation permit, you're good to go because you're sticking it in the ground. And then construction loan, whether that construction loan actually gets completed, because that's the very first thing you have to do before you're going to be able to actually build on the project, on the property. We don't have the construction loan closed, but we have negotiated through the term sheet. We have been through the appraisal process, and we have been through the banking loan committee process. And so now it's more of a formality with attorney docs and that sort of thing. And then raising the capital is the other big hurdle you got to get. And if you don't raise the capital, you send it all back. So those are the pitfalls. I mean,
And
once
how
you
about-
get the
I was going to ask you, how about the delays? Any delays, would they impact the returns or any distributions, timelines? Would that be impacted?
So there is a delay, obviously, guys, this is common sense. If there is a delay, there is going to be basically some delay in distributions. That being said, talk is cheap and actions speak louder than words. This is our 10th iteration, 8th project, and like Caleb was saying, what, the 45th, 44th building we're building? What is
Yeah, I'd
it?
have to do the math. I was shooting
Yeah,
from the hip there,
somewhere
but it's
along-
close. It's close.
So by this time, guys, any of these, our idea from start was basically to build an assembly line type product. Like, you're on an assembly line, everybody does one thing and goes forward. That's what we've been successful in doing. But yes, it goes without saying, if there's ever delays, God forbid there's an earthquake or all the tornadoes in the world decide to hit this one spot exactly at the same time, yes, there's going to be a delay. But our track record, our past projects indicate that that's not really the issue.
Well, Omar, I've actually had a tornado hit one of my buildings, and
All
we
of
did
them?
one of them, but it wouldn't have mattered because we got paid rent on that building
Oh, yeah, I
when it
forgot
was
about
down. So we got paid rent. So we got paid just as if it was completed anyway. The project, that's our best project we've ever done, and it got hit by the fourth building got leveled by a tornado. So even when you say tornado hits all the buildings, we're still fine because we have really good insurance. So when I go through this, the biggest hurdle from my point of view, the biggest risk is that your land doesn't get zoned, and then you don't have a deal. So the land's already zoned, ready to go. Caleb's almost got the building permit approved for the foundations. That should be ready around May 1st. We've done the building over and over and over and over. Caleb has an amazing reputation. Velco has an amazing reputation with the city. And so like everything that had, like, there just isn't any delays. There's very few delays that happen.
One thing that is kind of always a potential pitfall is massive price increases that happened during COVID. Now, I've only seen that one time, and that was during that time frame. But how we kind of combat that is we shorten the amount of time where that is a potential problem for us. And as soon as we know we're going to build this project, which is anytime in the next 4 weeks, we're trying to buy out that project, meaning on the construction side, we're signing POs with subcontractors, we're fixing our price with suppliers, and we're limiting that because everybody that's a part of the project is getting a contract written and can go and go get their supplies.
Was the biggest delay that we've had in the past 4 years was the panels, right? Electrical panels were 2 months
Yeah.
delayed.
Yeah.
So that's the biggest thing I can remember, and it pushed the project back 2 months.
Yeah.
Thanks. So this is the numbers slide. Basically, here's the numbers meet the reality, I would say. The pro forma for 4 years, or you can say 45 months. And Omar, you want to talk about that because you're the numbers guy?
Yeah, look, I can talk about it as much as you like. But guys, look, the pro forma or what you're seeing, this is just the end byproduct of all the research and everything that we've shown you so far, right? So this is basically the end byproduct. Vinki can share the model with you if you so choose. But because we've done these so many times, you can see that there is a ramp up basically from year 1, which is operating year 1, okay? Ramp up all the way from year 1 to year 4, So you can see revenues increase. Really, the big ramp up is between operating year 1 and 2. Revenues increase, and then expenses are managed. And as you get later into the project by year 3 and 4, a full tax load, real estate taxes hit you. And then you can see basically how the NOI is going up over a period of time. Year 1 is low. That's because you're leasing up the property. By the time you really get into years 2, 3, and 4, that's when you see the full stabilized effect of everything.
Great. So this is the sensitivity analysis that we have for this current project and the returns. And I think this is the exit cap rate 5.75, right? That's what we are projecting. And anything you wanted to add here?
No, guys, look, typically for newer build assets, people are acquiring them anywhere from low to mid 5%. So having a 5.75% exit cap rate is a very conservative estimate, especially because our return on cost is about close to 7.7 or 8%. So it gives us a nice healthy spread.
And also you wanted to talk about how you account for the potential cap rate expansion. Remember how we were talking about
Yeah,
there
so
is
this
wiggle room
sensitivity
for
chart
us.
shows you.
Yeah.
No, but this sensitivity chart shows you, look, if cap rates are higher, your valuations are lower. If cap rates are lower, your valuations are higher. So you can see, assuming cap rates go up or down, how your potential returns can be affected, both on IRR, not both, on IRR, equity multiple, and average annual returns. But this gives you a good idea to understand a range of outcomes.
Great. So this is my favorite slide that I would like you to explain us a little bit more, like I was asking you earlier when you're talking about the tax benefits. So this project has something called tax credits. So if you can shed some light on that, how does the tax credits work and what exactly this 45L tax credits are?
Caleb, do you want to take it? Because you now are an expert on this. Even I think you're the best. You've done the deepest research on this.
45L tax credit is a tax credit the federal government gives you per unit on the energy efficiency of the building. And so that energy efficiency can be done, through actual testing in the field or just the plans being reviewed and it meets some Energy Star rating. What's kind of interesting about Foss Fields Phase I is in January 1, they actually changed the rules. And they made it more stringent for energy ratings to receive the 45L credit. It's 45L credit is $2,500 per unit, or $5,000 a credit per unit. And we're still kind of working through the exact land because we have to potentially change our HVAC unit that's going to sit in each individual apartment. But it looks like we're going to actually be building this with a $5,000 credit for the project per unit. And so everything that you're seeing here is based on a $2,500 unit. But there's this kind of, you have to do so much more to get to 2,500. Than you did last year, and not so much more, but you have to do a few different things that you might as well go a little farther and go get the $5,000 credit. And so that just is through an application. It's really not even an application. You hire a third party to come and verify that your unit meets those different criteria through the equipment that you purchased and how it actually performs on an air blower door test. And then they verify that you've met the criteria, and then you just put it on your tax return and you receive the tax credit. And that passes through to the investors.
Right. When it passes to the investors, what would it look like from an investor perspective, right? How much they can write off, basically. I think the way I understand is like 1-to-2 ratio, right?
Well, let's say you have a tax liability of $50,000. Just in your annual taxes, you're going to pay the government 50 grand. But you're going to receive a certain amount of tax credits on whatever basis, however much you invest from this project. And let's say you receive $4,000 in tax credits. You would now owe $46,000 to the federal government instead of 50. So that's what the tax credit does. And that's different than depreciation. Omar, if you want to hit depreciation.
Sorry, thank you, Caleb. The biggest thing here, guys, is 45L tax credits. You do not have to be a real estate professional to fully take them in the year you get them. with accelerated depreciation due to cost segregation, which is really depreciation write-offs, you can only offset passive losses with passive income. So if you don't have passive income from the year, from other projects, you are going to carry forward these things. So while the depreciation is valuable, tax credits are more valuable, especially for non-real estate professionals. And again, this is assuming the current bonus depreciation rules. Right now, the administration has hinted and guided towards them bringing back 100% bonus depreciation. If that comes in, these numbers will go higher.
Great. Thanks for that. We do have a couple questions. And again, from Kyle, the first question is, how will you handle probable increased construction costs to build this? Highly likely with tariffs unknown that lumber and costs will go up. Have you accounted for this probability or possibility?
Said that a few minutes ago, with the contingency and how we build it and how we contract the projects.
Yeah,
Great.
and
I
Kyle,
think you
on
covered
your
that.
second question about do we have basically money in this deal, Kyle, while we are still finishing out the raise, to give you an example, our typical co-investment on past projects is 15%. This means on average, we have basically invested 15% of the total capital, which is our own capital. So that gives you an idea.
Plus,
We
we
also
sign on
signed
the
the debt.
debt.
We sign on the debt, guys. This is recourse debt. So unlike, say, just conventional value add deals, these are personal guarantees. So God forbid if something goes sideways, we are personally on the hook for everything.
That's good. Thank you so much. And last but not the least, this is a track record. These are the deals that's been sold. I think I showed you that earlier. And these are some of the current holdings. And these are some of the case studies that's underway. And then pretty strong track record for the team. This looks good. And if you like the presentation, what we shared with you guys today, please go ahead and reserve your spot. And you can contact me, Vinki@loombainvest.com, or my phone number is there as well, 925-250-3907. We'll love to have you on board on this project. And any last minute questions from anybody? I think there is something else in Q&A. Let me see. Would you consider $50K for an accredited? Yes, there might be possibility. Please reach out to me and we can talk. No issues. So thank you everyone for joining. And team, do you have anything else to add?
No, I'm very grateful for the privilege of Vinki, you hosting us. Thank you everyone for coming out. If there's any questions, please direct them to Vinki and we'll be able to answer anything.
Yes, definitely.
Thank you.
I'm sorry, and one more thing I wanted to add here is, and this opportunity is qualified for 1031 exchange as well. So as long as you're coming, I think minimum of $500,000, like 500,000, like we're talking earlier, we are accepting that as well for the 1031. Okay, so once again, if you're interested in this project, we'd love to have you on board. Please reach out to me, or I put the link in the chat. Please submit your soft comments and we'll reach out to you guys.
Kyle asked, what's the deadline to invest?
So the deadline for this current project is I'm going to close the raise on April 20th. We have a couple more weeks at this time. We are just asking for the soft commit, and then we'll call the capital as we get closer to the deadline.
All right. Thanks, Vinki.
Wonderful. Thank you, Vinki. Thank you, everyone.
Thank you, everyone, for joining. And then I'll see you guys. Have a good one. Bye.